Okay, so this is the fifth video, and where I left off in the prior video number 4, I was talking about uh, how this section here. This is a problem that I just made up pretty much to try to go through the whole accounting process and show you the whole accounting process with specific numbers and various entries, and I'll be explaining them as I go through. So we went through the first point where Nico wants to establish a candy store, and his sister Maya CPA has recommended that he follow GAAP. And so Nico has decided he's going to follow GAAP because it's better for his financials to be in accordance with GAAP. That way it's easier for investors and creditors to understand them, because they generally know the rules established by GAAP, and at least those with financial knowledge, and so they'll be more comparable to other competitors in the industry. And also in the future, if Nico ever wants to make his company public, well, it's just going to be a lot easier to transition into a public company. So he's going to follow GAAP, okay? So it says in this bullet point, I left off in this bullet point. So in this bullet point, it says, though being a private company, Nico does not have to follow GAAP. He realizes that doing so from the beginning would make it easier to transition to a publicly traded company in the future. So he decides to do so. And his sister Maya and brother Lucas will join him in the business as equal partners, and they will call the store NAL Candy. Okay, so there's going to be two sets of transactions. First, I'm going to have a pre-opening day transaction. This is done in the month of December of 2014. The whole purpose I do this is because I want to establish a beginning balance sheet, just so that you can see how the balance sheet changes from beginning point 1 or year 1, time period 1 to time period 2, and what affects those changes. And once I've established the beginning balance sheet through here, then we'll go through some transactions in January of 2015, and I'll go ahead and show the whole process of journalizing, and then posting to the general ledger, and then creating the income statement and the balance sheet. And then we'll also do some adjusting entries for that month, and that will be the month of January of 2015. Okay, again, I apologize if this video stops abruptly. If it does, then go ahead and just simply log into the next video that should be uploaded. Okay, so let's start with the first transaction, and let's go ahead and read it. And what I would suggest is you go ahead and you print out this page. You could put it in pause, print this page out, and have it in front of you so that we can go ahead and do the December transactions, because I'm going to shift over to this tab. Let's see how easy it is to go from one tab to another while recording. Well, it's not that bad. Okay, so I'll shift from tab to tab. Okay, so first one. Each sibling formally invests $100,000 in the store for a total of $300,000 and receive 100,000 shares each. Okay, remember, I'm going to be treating this as if it was a public company. In reality, private companies don't have to do this, shares or any of that, but this whole example, I want to do it as if it was a public company, so that you could start learning, because that's what we're studying in this class. Pretty much the accounting that's to be followed by publicly traded companies. So they create 400,000 common shares with a par value of $1 and recorded the transaction just as if NAL Candy was a publicly traded corporation. Okay, so they're going to have 400,000 common shares issued, and they're going to have 300,000 shares outstanding, right? for $300,000. So what's the first entry that transpires over here? Well, the first entry that they do, and I've already set this up, so all I have to do is highlight it and darken it, is now the company has begun. The company has begun, and the company has a debit to cash, right? Cash is an asset account. So you debit it, and a credit to common stock, which is an equity account. So you credit it. So both of these increase, right? Now, and then you could also put a little note here, and it says 400,000 shares issued, 300,000 shares outstanding. This is not necessary in the journalizing step, but you could also put, little notes wherever you want. Okay, so you can see we have the date here, December 1st. We have the posting reference, which refers to the general ledger that you've posted to. For the moment, it's empty because that's the second step. And one thing that I want to do is I want to, show you how over here I have the balance sheet, and I want to show you how the balance sheet starts evolving as we as the company starts to come into existence, right? So well, I'll do that part once we start posting it, okay, into the accounts. So that's the first transaction, and we've journalized it. Cash goes in and common stock goes in, and the company now has begun to exist, right? So let's go to the second transaction. NAL Candy takes out a $100,000 5-year 5% loan from a bank in anticipation of need of future funds. Okay, so these transactions, I'm just creating them so that we can create different types of transactions, and you can see how they are posted and how they're journalized. Right here we have equity investments by investors. Equity investment means the investors own a part of the company, and here we have investments by creditors who don't own a part of the company but lend money to the company. So NAL is receiving $100,000 in funds on a bank loan. So how do we post that transaction? Well, again, you're receiving cash, right? So cash probably will go up by 100,000, and it's the same account, and now you're going to book it in a notes payable for $100,000. Okay, so an asset goes up with a debit, and a liability, notes payable, goes up with a credit. Again, debits and credits match, and so this is in balance. Okay, and it says note matures in 3 years. I think this sort of doesn't match what I say here. I say 5 years. Okay, so let's put note matures in 5 years, and payments begin in 6 months. Okay, so Nico goes sees the management of the company of the store locale he will use and prepays a full year of rent up front. Each month's rent is $2,000, so Nico pays the management company $24,000. So he's paying $24,000 for rent that will begin in January of the following month, right? So is he expending it? No. He's simply exchanging one asset, cash, for another asset, prepaid rent. And as I told you in the previous videos, the expense is going to occur once this prepaid rent starts to lose value through usage. Well, once January is over with, you've used 1 month of it, right? So 1 month will be $2,000 worth, and so now the prepaid rent will be worth $22,000, and you're going to have to record an adjusting entry to bring the prepaid account down. Okay, on 12/14, $2,000 worth of supplies were purchased in cash. I'm going to distinguish supplies from inventory. Supplies are things such as bags, napkins, store cleaning supplies. These things aren't sold directly to the public. They're simply used throughout the operations of the business, and they're necessary, as opposed to inventory, which is sold directly to the public. Okay, so he bought $2,000 worth of supplies. Again, is there an expense here? No, there's no expense. You're exchanging one asset for another. You're exchanging cash, $2,000, for supplies, $2,000. When will the expense occur? Well, the expense is going to occur when you start using up the supplies, and you know, and they're no longer in your closet. You know, they're no longer in your store. That's when you're going to be incurring the expense. It's usually done during the revenue generating process, right? The store hasn't even opened, so you certainly haven't used these supplies yet. And what else? So I'm going to show you how, you know, we expense for supplies throughout this process. Okay, so on 12/18/2014, Nico purchases the candy making machine for $80,000. This machine is expected to last 8 years and have no residual value at the end of 10 years. That does not make sense. If it's expected to last 8 years, it should have no residual value at the end of 8 years, right? Okay. This machine is expected to last 8 years and have no residual value at the end of 8 years. Depreciation will begin in January. So let's take a look at this. I made the numbers very easy. It's worth $80,000 and it lasts for 8 years. So how much value does this machine lose per year approximately? Well, that's very easy to calculate. It loses $10,000 per year, right? And if it loses $10,000 per year, let me see. There's something. Let me see if I should use the 8 or the 10. Give me a second here. Let's see what I put here. Well, I guess I'll have to figure that out later. But anyways, if Nico purchased if it's $80,000 and it lasts 8 years, then the depreciation is $10,000 per year. And how much is the depreciation going to be per month? Well, the depreciation per month is going to be $10,000 divided by 12, and that's going to be $833 per month. And I'll double check this to make sure if I should use 8 or 10. And I'll correct it and I'll let you know if there's a change there. But for now, all we're doing is we're not going to book depreciation. We're just going to book the asset, right? Because it hasn't begun to lose value. So we book the asset, and the asset again is an exchange of cash for equipment for the candy making machine of $80,000. Okay, so now we are going to come over here and we're going to say Nico purchases $60,000 worth of inventory for the store on account to be paid within 60 days. Okay, so this is inventory as opposed to supplies. Inventories are the candies that are going to be sold directly to the customers, right? So we will go ahead and book inventory here. Again, this is an asset for an asset. Well, I'm sorry, not an asset for an asset, because we didn't pay for it cash. We purchase accounts through account, right? We're going to pay for it in 60 days. So you create a liability, accounts payable of $60,000, and in exchange for an asset, inventory. So now we have an inventory of $60,000 and we have a liability of $60,000. And last but not least, because I'm running out of time and we'll continue in the next video, Nico invests $50,000 of cash in a 6-month treasury bill earning 4%. Both principal and interest are returned at maturity. This is classified as a short-term investment because cash equivalents, which you'll learn about a little bit later, must have 3 months or less to the date, or less from the date of purchase. Okay, so really quick, and I'll continue this in the next video. I'm running out of time. you can see you exchange cash for short-term investment. And we'll continue